Treatment of depreciation under IFRS. Under the International Financial Reporting Standards, IFRS, depreciation is treated as an important accounting concept for allocating the cost of an asset over its useful life. Here are some key points about the treatment of depreciation under IFRS. Useful life. IFRS requires businesses to estimate the useful life of their assets. Useful life refers to the period over which an asset is expected to generate economic benefits for the company. The estimation of useful life depends on factors such as physical wear and tear, technological advancements, and legal or contractual limits. Residual value. IFRS also requires businesses to estimate the residual value of an asset. The residual value is the estimated value that the asset will have at the end of its useful life. It represents the amount the company expects to recover from the asset after its useful life is complete. Depreciation methods. IFRS allows several depreciation methods to be used, including the straight line method, diminishing balance method, and units of production method. The choice of method depends on the nature of the asset and the pattern of its expected economic benefits. Straight line method. The straight line method is commonly used under IFRS. It allocates an equal amount of depreciation expense over each period of the asset's useful life. For example, if an asset has a cost of $10,000 and a useful life of 5 years, the straight line method would allocate $2,000 of depreciation expense each year, $10,000 divided by 5 years. Depreciation expense. Depreciation expense is recorded in the income statement as an operating expense. It reduces the reported net income of the company for the period. By recognizing depreciation expense, businesses match the cost of using the asset with the revenues generated during the same period. Accumulated depreciation. Under IFRS, the accumulated depreciation of an asset is recorded in the balance sheet as a contra asset account. It represents the total amount of depreciation expense recognized over the life of the asset. Accumulated depreciation is deducted from the original cost of the asset to determine its carrying value or net book value. Disclosure requirements. IFRS requires businesses to disclose information about the depreciation methods used, the useful lives and residual values of assets, and the carrying amounts of assets and accumulated depreciation in their financial statements. This information helps users of the financial statements understand the impact of depreciation on the financial position and performance of the company. Overall, the treatment of depreciation under IFRS involves estimating useful life and residual value, selecting an appropriate depreciation method, recording depreciation expense in the income statement, and disclosing relevant information in the financial statements. These requirements aim to provide users of financial statements with transparent and reliable information about the value and usage of a company's assets over time.